Everybody, Corey Singletary here with the Citizens Utility Board with another episode of CUB Tracks, and we have another episode of kind of Meet the Staff, Meet the Team. We've sat down with Kara Coburn-Ferris, our General Counsel, and next in the hot seat is our Regulatory Strategist for Economics and Finance, Dr. Steve Kihm.
Hello.
Steve. And so, like I mentioned before, Tom and I have been talking for a while, and we thought it would be great for the public, for folks to kind of meet the members of our team and learn a little bit more about folks who work on their behalf. You, unlike some of our newer additions to the team, are not new to the utility industry.
I am not. I have worked. I started in 1980, before a lot of the people that I work with were born. So that's 40 now, in my 43rd year. So I've been around, seen a few changes.
You have seen a few changes. And so maybe you want to give a little background on your, hang on.
Sure.
I'm making loud noises here. You want to get a little bit of background on yourself? And,
sure. Sure. So let's kind of do it maybe chronologically. That's a good way to start, if that's okay.
Yeah.
So I, interestingly, probably the only person that this has ever happened to, in the 1970s, I was an undergraduate at the University of Wisconsin-La Crosse, which is my hometown. La Crosse is my hometown. I started reading about the PSC, which is a pretty obscure agency for most people. And Charlie Cicchetti was the chair, and the Tyrone nuclear plant was at issue. Northern States Power wanted to build it. The Eastern Wisconsin Utilities wanted to build the either Haven or Koshkonong plant. And Cicchetti was a pretty bold chair, and he essentially denied those. If you can imagine denying these 1,100 megawatt units, which was just changed the landscape. Luckily, and this is my favorite story, in March 12, 1979, the commission denied the Tyrone application, formally rejected it. On March 28, 1979, 3 Mile Island accident occurred. It was the best gift that the utilities could have had, because after that, all the costs went through the ceiling. But anyway, so I was watching all of this from the sidelines. And I thought, well, I'd really like to work at the Public Service Commission. Nobody that I knew knew what that was, and I actually found my way there. So I started out in the systems planning area. I was getting my master's degree in quantitative methods from the business school. I had an undergraduate degree in economics from the University of Wisconsin-La Crosse. I was now in Madison. And I started doing consumer impact analysis, which is sort of interesting in today's energy justice and energy burden world. I was actually doing a lot of that. And at the time, utility rates are going up 14, 15, 16% a year. It was really, inflation was high, incomes were not going up. And I worked more into the financial area fairly quickly during the 80s. But then I went in for a short while, for 5 years or so, I worked as a consultant with MSB Energy Associates. And on the way, I got my second master's degree, that one in finance. I also, in 1992, got my Chartered Financial Analyst certificate. And then I came back to the commission in 1995, and I did a variety of finance and planning things. I did a lot of natural gas price work. 2007, I went to the Energy Center of Wisconsin, worked there until 2021. And then I joined, let's see, when did I start?
September 2021.
September 2021. Then I landed here. So that's sort of my chronological history. But my, and I got a doctoral degree on the way there as well. Picking up these credentials along the way. So I have been in my adult life, I've been in the utility regulatory arena. That's what I've done. I've testified, I don't know, I'm going to say over 100 times, maybe 200 times. I don't know. I've testified from Maine to Hawaii as my consulting role, and then a lot of times in Wisconsin. I've written articles for the Energy Law Journal, Journal of Applied Corporate Finance. So I'm pretty much it. This is my life. This is what I do, and I'm going to keep doing it as long as I can. I enjoy it a lot. So.
Yeah, you and I have a little bit of that shared experience. You were there much longer than I was. We both worked at the commission as commission staff, and that kind of, I don't know, it gives you some interesting insights in terms of how things work. But maybe before we talk about that a little bit, so like you'd mentioned, you joined our team in 2021. And a little bit it was a serendipity in terms of the office that we're in now, but I guess why CUB? What was attractive to you? What was appealing to you about joining the CUB team and working for the consumer advocate?
Well, with my personality, I'm going to either work on the staff or an advocacy organization. I'm it's not that I'm opposed to utilities, but I'm more of a let's make sure that the people that don't as many resources are heard. I actually love analytics. That's really, I want to do a good job. And I think they're just opportunities you didn't have a finance person here before. It's very common with advocacy groups. And so it was a nice fit for me to come in. And I clearly have this rich history of experience. It's pretty hard to ask me a question that I haven't been asked before in 4 decades. It just is natural. It's a natural fit for me. It's where I feel comfortable. I like the work. So opportunity came up as you remember this, entry-level financial analyst.
That was what we were hiring for.
So you got a 40-year experience, doctoral CFA, so I had to kind of finesse that a little bit in the interview. But you guys saw that you could make use of me. But so it was kind of interesting that I applied for the entry-level position and got it. There was some adjustments along the way, but that's how life goes.
It's not always the case that if you apply for a job for which you are heinously overqualified that you will get hired, but it's never a bad idea to try.
And on that point, I'm certainly doing more than I've redesigned the job so that it's not. I'm not doing entry level work. I'm doing advanced work. We just took the opening and converted it into an advanced position. So that worked out well.
That is one of the benefits of working for a small organization. Right. It's a little more choose your adventure on what you make the job. So you have all of this experience, multi-years in the industry, whether it's commission staff, as a consultant, different roles. And you touched on this a little bit in terms of making certain that the customers, the folks that don't have the resources, are represented and can have someone speaking on their behalf. Can you, from your perspective, with the experience, all the experience you have, can you talk a little bit about what you feel, why you feel CUB and other consumer advocates, but CUB is important to customers and the process in general?
Well, if there weren't a CUB, then the consumer impact, residential and small commercial, would have to be sort of picked up by the staff as best it could. But staff's really kind of in the middle of the middle lane here. They're not in an advocacy position. That would be a pretty big deficit or a void. There would not be someone pointing out, like the staff would likely point out some issues. This is this, but they're not going to advocate for a particular position. So in addition to actually providing evidence, because the staff can't present all the evidence either, in addition to providing evidence, the CUB can take an advocacy position and push an issue. And it just wouldn't happen if there wasn't an organization like us. There would be no one who could play that role. So we're certainly not redundant. It's an important role that needs to be played.
I think that's something that a lot of people maybe don't know. For folks that have even a passing understanding of utility regulation, and they understand that there's this regulatory agency and there's a commission. A lot of folks may not understand that staff has a particular role, and it is more that middle ground that you and I have both under different in different environments and different political climates have had to work under, and that's a challenge.
So let's look at it. We talk a lot here in this office, especially with Kara, about some key Supreme Court decisions. What is a regulator supposed to do? They're supposed to balance the interest of consumers and investors. That sort of makes perfect sense. That's a public policy situation. The utilities will take care of themselves. To their credit, they're supposed to do that. Okay, they will bring in evidence that supports them. If you think of the commission staff as sort of the middle of a teeter-totter or seesaw, that's where they are. They're in the middle. We got the utilities on one end. You need somebody on the other end of that teeter-totter, or you're not going to. It's just going to be an imbalance, and that's because the staff. I think it even says in the Wisconsin statutes, does not advocate. It takes it presents evidence. So you just would be missing this thing. So no matter how committed or well educated a staff person would be, their role is different. It's simply institutionally different, and so that's where we come in and can offer recommendations, push things harder. Staff's really about presenting a complete record, not so much pushing anything, whereas we push. That's because the utilities are pushing, or our teeter-totter thing. The staff sits in the middle to try to make sure that all the pieces are there that the commission can decide. I'm not quite sure where my metaphor is going with that, but basically they're never going to be on the end where we are. That's just not their role.
So thinking back over your career, both in commission staff and all the other roles that you had, what's probably the one thing that you think would be the most surprising to people who don't have the kind of inside experience that we have with the utility industry? What would be the most surprising to the average utility customer, residential customer, about how this whole system, utility regulation, the utility industry works? I'm putting you on the spot with an interesting question.
That's fair enough. Fair enough. That's a good question. I'm going to say, and you've heard me talk about this before, is that if you were to look, if you came into a case fresh and no one had ever told you anything about the case, and the commission didn't know anything about the case, and looked at it what we call de novo, looked at it fresh, I would bet you'd get different decisions than if the commission had made that decision 17 times before. There is a strong public policy has a strong inertial force, meaning it's hard to move it once initial decisions have been made, even if someone has good evidence. And you know this, Corey. Sometimes we have fantastic evidence, and the rebuttal is weak, if not even sometimes non-existent. But
This is the way we've always done it.
That's right. So if you were to just look at the record, the transcript and the exhibits, you would say, the Citizens Utility Board or some other party made this point. Looks good. No one's rebutted it, but the commission essentially just took a pass on it because for the past 23 years it has looked at it a different way. So that's not so much to disparage the commission as much as it is to say that public policy decisions there's so many that need to be made. Like in a rate case, how many, like 80 decisions they have to make as they go through the list? If you had to think hard about it each time about every one, it becomes an exhausting thing. So to get a policy change, you really have to push hard, and you have to do it more than once. And that's what we do. We keep bringing things back. So if we don't get it this time, we may have to bring it back 3 or 4 times. And then as the commission changes, because the commission's terms are 6 years and a lot of people don't stay the full, we get new players, and we just keep trying to move the ball. But if you were to just if it were an academic seminar, this is what I always say. I think the decisions would be different if it were an academic seminar, because an academic seminar is like, well, what's the evidence? What's this? I don't care what somebody else says. That's not how the scientific method works. It's like, what can you prove and what can't you prove? Public policy is several steps removed from that. And it's just that inertia is the thing that I think would surprise people, that sometimes the best evidence, at least initially, doesn't move the ball. It might eventually, but initially, it's much harder than you think to get a new policy implemented.
Yeah, that inertia and I don't know, tradition or appeal to
Yeah, there's logical fallacy called appeal to common practice or appeal to status quo. We all do it because if we have to think about every one of our decisions every time, as I said, it gets exhausting. But when you're in a case in which evidence should matter, that's very frustrating when it's just clearly too much for the policymaker to reassess that. And when in doubt, think of us, what do we do as humans? When in doubt, we go to what we know. And if we know that we did something in the past, we don't necessarily know it's right. We just know we did it. Mm-hmm. And this new idea that Corey has presented or Steve has presented or Kara has argued in a brief, these new ideas, oh, those are interesting. Did we do it that way last time? No. How about the time before? No. Now, that new evidence might not have been in any of those cases. So that's not really, the logical trail isn't really complete. But precedent, status quo, or the court would say stare decisis, let the decision stand, the old decision stands. That's really powerful. And that is probably one of our biggest challenges, is to try to overcome that when we have an idea that we think is really better. There's a lot of times where it's just a debate between this or that, and you can see either side of it. But sometimes it looks like one thing is clearly better. And even then, it's hard to prevail.
Yeah, that evidence part that you had mentioned, I know we've been in discussions internally where I've expressed frustration where a commission seems to not understand that a particular party or the utilities argument, if that evidence were in the form of a paper that were presented in an academic setting to a professor, that you would get an F on that. Right? And I'm like, how is it that this is okay here? But
yes, without being too disparaging, we know that certain things that are said in cases are matters of debate and disagreement, and certain things are absolutely incorrect. We can show that they're incorrect. That may not be sufficient to show that they're absolutely incorrect. Now, doesn't happen all that often, but there are certain things that are like people will make a statement. I'll give you an example of a statement that we know is incorrect. Economists' forecasts of interest rates are the best forecasts out there in terms of accuracy. That has been proven to be absolutely false. They are terrible forecasters. Why? Because they're trying to second guess a market, and everything that the economists know, I'm an economist, is already in the market. So you should just take the market rate. And study after study after study will say that, but we'll get evidence presented in cases that says, oh, no, these are the best forecasts. We can't use today's interest rate, which is actually optimal. We have to use these forecasts because they're more accurate. And where's the evidence that they're more accurate? There is none. But it sounds good. Doesn't it seem like people who get paid a lot of money to forecast interest rates would actually know? Well,
you'd think.
The thing is that they're actually not really paid to forecast. Economists on Wall Street are paid to do a lot of things. And by the way, they'll forecast interest rates for you. They're just not very good. I mean, you can't beat the market. So if that's all they were paid to do, they wouldn't last very long. They're paid to do a lot. Look at economic variables, macroeconomic variables. One of my I don't know what the word is, roles is I help the Federal Reserve Bank of Philadelphia do macro forecasts, macroeconomic forecasts. Now, there are certain things that I can weigh in and that my colleagues, experts can, like how about non-farm payrolls? That's not a market-traded item. Somebody's got to figure out what that's going to be, and the evidence is that, at least in the short run, those forecasts are more accurate than just saying it's today. We can do that. But interest rates, things that are publicly market traded, there's no evidence that those forecasts are accurate. So it's putting them into different bins. So the people that are paid to provide forecasts are actually contributing. There's about like 14 variables in the macro set, 4 of which are interest rates. They're contributing on 10. And by the way, they'll give you the other 4. I always just put in today's rate. I'm actually working on my latest one now for the second quarter of this year. It's due on Monday, my forecast, and it's like, well, what's the interest rate? What's today's rate? That's easy. Boom. Now, non-farm payrolls, I have to spend a lot of time trying to get at that. But that's an example of where the conventional wisdom is that, well, people on Wall Street must be smart. They are, and they must be paid a lot. They are, and they must be good at forecasting. Well, they are good at forecasting some things. They're not good at forecasting everything. And so what we get is a story. And you know that story in life is more powerful than evidence. It's the story is I'm taking these highly paid people, their expert opinions, and I'm going to use that. And if that is an F in the seminar, if you presented that, this is not. I'm not being facetious. From 2001 to 2020, the forecasts of the 10-year Treasury note, which is an important driver of cost of equity, from the Survey of Professional Forecasters, was too high 20 years in a row. You could not do that if you if you were trying to be that bad. But they're actually not trying to be. They actually have some incentives to overforecast in that area. So if you really understand and you can parse out I'll take a non-farm payroll forecast from these, but I'm not going to take an interest rate forecast from these people. That's an informed way of looking at these things. But the commission has to be an expert in law, economics, engineering, accounting, and it might be counterintuitive to them. And whenever it's counterintuitive, then we're in trouble. If our argument's counterintuitive, because the idea that these people would be so terribly inaccurate. In fact, there was a case in which the witness, actually there was an attorney for the party, stood up and said, that cannot be right. They cannot be wrong 20 out of 20 times. And my answer was, well, if you have any data, I'll look at it, but do you have data? No, I have the data. I have all the data. So that is really frustrating because that is not a question of debate. It's what they call in the legal field, asked and answered. Can economists forecast interest rates with any reasonable degree of accuracy?
No.
Mr. Singletary? No, that's it. That's the end of the discussion. But you'll get it in every case. You'll get forecasts of them in every case, and that is one of the things we're trying to ferret out. It's like, commission, please don't use these. There's a rate that's sitting right in front of you. I can look it up on my phone. Here it is. This is the most accurate forecasting tool of interest rates is an iPhone. Just look it up, see what it is today, and that will actually be the most accurate forecast going forward. That's counterintuitive, but it actually is. But if you think about it for a little bit, what's in that point? The bond market is $46 trillion monolithic giant thing. It's all the combined wisdom of all the investors have gone into that point. $46 trillion, not just people saying things, but $46 trillion of money. So it shouldn't surprise us that that's actually it's not perfect. That doesn't mean that the current interest rate is 100% accurate. It's just the most accurate. Sometimes it's high, sometimes it's low, but on average, it will have the lowest error. And as a commission who does rate case after rate case, if they were to use it consistently, they would have the lowest errors.
I feel like sometimes there are days and sometimes there are months when I feel like the biggest struggle that we have, particularly from the consumer advocate end, is getting the commission to accurately distinguish, or correctly distinguish between what you described. Issues where there are reasonable differences of opinion, where and then there are things where there are just facts, right? Where a statement just cannot be reconciled with the historical evidence, with the data. And so there should be some things that we're not debating, we're not fighting about, and those are very simple. And then we can we can reserve all our energy and efforts for the things where there are reasonable areas of disagreement.
I would say there's sort of like three bins. There's issues that are really important. Maybe I don't know if there's three or four or whatever. And there are issues that aren't very important. Okay, and then within each of those, I guess there's four. There are things that actually they might be really important, but we actually know what the answer is. And then they might be really important, but we don't know that, okay, now that's where all the action should be. Over here, where they're not that important, we still might know what the answer is. But even if we don't, it doesn't make that much difference, But it's the ones that are important that we don't know the answer with should be separated out from the important ones that we know the answer. And I would say most of the ones are in the we don't know the answer. It's not that common that you actually know. But there are enough of them that they could be pulled out. And those should be pulled out and said the commission's policy is to use the market rate. The commission could establish a policy And then that would be done. Then we would use the 10-year Treasury note as reported on the day of. What we used to do back in the 80s is I don't know if they still do this, maybe they do, the staff would file the interest rates on the day of the decision or 3 days before the decision to get the most recent interest rate. That's actually good policy to say that is what but now whether the commission uses it or not is a different question. But getting the most recent data on a market-traded item like an interest rate is really good policy. So I think the commission still the staff files a delayed exhibit, I think. Yeah, so that's a step in the right direction. What does that interest rate say? Up or down? And you got to live with it either way. Mm-hmm. That's what it says. That's stepping toward taking decisions that shouldn't be debated and should be just known. Here's the answer. So that's a good step, but I don't want to make it sound like, most of the issues are, most of the issues are subject to all sorts of complex weighing of costs and benefits and parties that are affected. And that's deserving of a good record development, and fair enough, people can have good arguments on either side of that. And the commission's job, that's really, in theory, that's their job, is to sort out those really thorny big decisions in which there's not a right answer. Like, in cost allocation, there are a lot of the things are arbitrary. You can do it this way, you can do it that way, which is better? Mm-hmm. Don't really know. I mean, the commission has to make a decision on that. That's what regulation is meant to be, is to make those decisions. But when we throw items that are known, asked and answered in that mix, that's problematic. That shouldn't occur.
Yeah, there's pragmatic judgment, I think, is the language on that in terms of the commission's job and weighing between those issues. So you talked a little bit about the kind of stuff that you do generally, not just here with us, but with your experience and all the different hats you wear, mm-hmm. Even working here. At a high level, so we don't turn this into a PhD sort of mm-hmm. Seminar. What kind of stuff are you working on now? Because you're in a position where you don't have to be trying to drink from the fire hose and learn a whole industry. Right. So
I already drank. I already drank all that water. Slowly though, but. So the main thing, there are two big issues that I work on, and these are pretty. One is especially high profile, which is the profit rate of utility, or what's called the return on equity. It's a rate of return. That is distinguished from something called the cost of equity, which is a minimum return that's determined in a market. I like all these. Most of my work is looking at markets, and I can figure out a number. And then the commission uses, that's finance. And then the commission can use policy analysis to set a return on equity. And at the lowest you would normally want to set that is at that minimum threshold investor return. And if utilities do well, this is a case, you and I worked on this. If the utilities do well, they are deserving, if they do well in terms of not necessarily doing well for their investors, which is fine, they can do that, but they don't need to be rewarded for that. That's their own reward. If they do something that really benefits customers, then it's appropriate that they get a quid pro quo for that. And so you could have two utilities that have the same investor required return, cost of equity, and you could give one, let's say that cost of equity was 7%, you could give one 9.5% ROE and one 8.5% ROE. You'd give the one the higher ROE because they were performing well. They were doing something for customers, really helping low-income customers pay their bills, something that would be important to us. There could be other things that are important to other interveners, other parties. And you'd get the lower number to the utility that's not doing so well. That's actually a really powerful tool. That's the commission's biggest lever. But what we've done is we've gone to trying to solve this as a math problem. And it's not a math problem. So I'm trying to constantly, without going into the details, untangle those two returns. And you and I have done cases like that to try to, you do the policy, I do the finance. That's going to keep happening. The other one's a little more esoteric and subtle, but not less important, which is if you think about a business or think about your home mortgage. Some people just buy a house with all their money. That's an equity investment. Not very many people do that. They have a mix of debt and equity, and that's how businesses are financed, with a mix of debt and equity. And so we need returns for each of those components. Debt is This is going to be a little tricky because it's horrendously complicated. So I'm going to use some shorthand that's not actually down to, you don't want me to go down to the PhD level. But think of it this way. Debt's less expensive than equity. The real reason is because debt is tax deductible for corporations. It's actually not just on the surface, and I'm not going to go any deeper into that than I've issued my caveat here, so anybody who knows that has heard me say that. But debt is tax deductible. That actually makes it cheaper, and customers can get that benefit because we'll flow the tax savings through to the customers, whereas equity is not. So what you want to do is actually try to take on as much debt as you can without causing extreme reactions on investors' part. And it turns out that the utilities industry is going the other way. Let's actually take on more equity. So we're going to give up the tax subsidy. We're going to load up equity because, and the argument will be that they need that from a risk perspective. That's what I don't think is true. I think there's plenty of movement to go down. And as soon as I start going into this, then all the complexity comes in. I'm going to say this, and nobody's going to believe me, but it's true. You can actually increase your debt holdings, which will make debt more expensive and equity more expensive, but your overall cost will go down. You know why that is. There's more than two variables. That's just the cost rates, but you're taking on more of the less expensive capital and less of the expensive capital. And then there's a tax rate effect. And there's 5 variables in there, and if you did, you can show that you can often, like a utility with a bond rating of, say, triple B, there's triple A, double A, single A, triple B. So triple B is the least, it's the most risky, and they'll have a higher cost of debt and a higher cost of equity, but the weights will be different. That can often be the lowest overall cost of capital. Now, that is so counterintuitive that you have to show that. You actually have to show that mathematically. But we know that, like in corporate America, why isn't that in a non-regulated entity, they get all the benefits of reducing their cost of capital. That just goes to their bottom line. So they want to find the mix that's the least expensive. And what we found, so AAA companies have very little debt and a lot of equity. When I started at the commission in 1980, there were like 60 non-utilities in the country that were AAA. Now there are 2. Has the economy imploded? No. What has happened? Firms have realized that that's a terribly expensive way to raise capital is to be AAA. So the most common bond rating is BBB in non-utility sector. Why? Because it's the cheapest, even though your debt cost is higher. But we never get to that. We never get through that math usually. We just did it in a couple cases. We did some of that math, and one of our commissioners picked it up and got it. But the idea that if your debt cost goes up, that your cost of raising capital will go down is easily shown with mathematics and actually with real data, and almost impossible to understand if you don't look at the math. So that's a challenge I have, and that's going to be one of our bigger issues in the coming year we've focused a lot on the rate of return, the profit rate. That's easy to understand. Guess what? If you raise the profit rate, customers pay more.
Bigger number, more money.
That's easy. That's easy one to deal with. The capital structure, because it's 5 variables, not 1 or not 2. If I can't put it on a piece of paper, I can't tell you whether it's more expensive or less expensive without running all 5 numbers. And so that easily slides into the wrong pile in terms of, this must always be more expensive to have a bond rating downgrade. No, that's not. Usually if the commission is taking actions that either lower the ROE or reduce the equity ratio, it's almost always cheaper. That surprises people, but if we do the math, it's almost always cheaper. But the common thinking is, because it now costs more for debt or equity, that it must be more expensive. And that is, again, one of our Herculean tasks, is to try to say, wait, let's really look hard at this. But the anecdotal evidence is, why did we used to have 60 AAA-rated companies in the United States and we only have 2? Well, they don't have a regulator watching over them. They get to make that decision themselves, and they're like, wait a minute, every percentage point that we knock our cost of equity down. That's just money for us. And so we can use that as sort of, sometimes a story is more powerful than the analytics. But I have got my hands full with that one. As you can see, it's the 5 variable problem does not lend itself to a nice, simple story.
Well, and as we were talking earlier, even if you can put it down in numbers on a sheet, the commission, you have to kind of convince the commission to get past the rhetoric by the utility to even look at the numbers and try to convince themselves.
A bond rating downgrade is viewed as fatal when, in fact, it's often accompanied by a lower way of raising money. I mean, again, I'm going to say this again. The cost of debt and the cost of equity can both go up, but if you change the mix, the overall weighted average can go down. That's just a simple problem. That's just a math problem. But we never get past, like, a bond rating downgrade is viewed as like a alarm bell. Well, we can assert that if commission lowers ROEs below 9, guess what? Utilities are going to get their bond ratings downgraded, and customers are going to pay less for capital. They're not going to pay more. They're going to pay less. That we can show. But again, we've developed sort of a way of thinking about finance that is intuitive, which is bad because I have a great book by Michael Mauboussin, who's at Morgan Stanley, called Think Twice: The Power of Counterintuition. People that are intuitive on Wall Street actually don't last very long. They get chewed up by the people that understand that finance isn't intuitive. It's one of the most counterintuitive fields. And so if you really dive into, or there's a book by Professor Desai at Harvard, The Central Intuitions of Finance Are Slippery. That's a good way to put it. These are not, the people think that finance, like, I do training at Michigan State, and I used to do in-person training, and commissioners would come up to me and say, I'm not going to come to your, it's, comprehensive training. Mm-hmm. I'm not going to come to your finance session because I understand finance. And I remember asking this one commissioner, can I ask you a few questions? I asked him three questions. He got them all wrong. I said, I don't think you actually answered. Man, I'm not shy. I said, I don't think you actually do understand finance because you got all those wrong. And then he still didn't come to my session. But that's actually a good, like, I start off my lectures with here's a quiz for you. Let's see how many you can get. And I often do. There's some that are just sort of like crazy. You've seen this one. Like, I start off, people ask questions in the audience. How many stocks in the S&P 500? It's an easy one. And of course, there's 503. That's not really but that's just a funny example. But as you dive deeper, the intuitions peel away pretty quickly, and you're left with some really interesting. Once you understand them, it's like, oh, that's how that works. And if you do a seat of the pants intuitive finance, you're never going to get there. And so this is another uphill battle for me, is like to say, no, what you're thinking, you think economists can forecast interest rates, you think that analyst forecasts of growth rates are accurate. You think that a higher cost of debt means a higher cost of capital. There's a whole list of these things that, my job is hard. It's like, because it's counterintuitive, but I'm not the only one that says this. This is what, like Maubussin's book at Morgan Stanley, he's an equity strategist, a real good writer. He's like, I've seen so many people fail because they don't understand that you have to actually look at the problem. And finance isn't horrendously complex once you get into it. You just have to actually get into it. If you're not willing to step in, you're not going to you're not going to get the insights. So that's sort of like my career in a nutshell, is trying to fight the intuitions. I actually like intuition. Intuition is a powerful decision-making tool when you're making a repeated decision. That is, and you've done it right. You've done it right. You learn, and then quickly you don't need to see how you can sort of assess something. But if you've been wrong time and time again, then your intuition's your enemy. You're going to just keep making the same error over and over again. And I feel like Warren Buffett says, the reason he does so well is that people make the same bad decisions over and over again, and he doesn't. That's exactly right. He understands how value is created. He understands that you don't earning the cost of equity is not a good thing. That's a value free. There's no value gain there. You've got to earn more than that. That's his big thing. It's like you want to create value, and all these other people are out investing. Well, I made the cost of capital, and he's like, then you've done nothing. So if you read his letters to shareholders, he's got a lot of good insights that carry over to us. But this idea that finance is intuitive is the biggest bugaboo for me to try to fight, and we keep fighting it, and we make little progress here and there, but maybe someday we'll have a revolution and people will say, oh, I guess maybe we should actually look at the numbers and look at the concepts. That's my task, which is I enjoy it, but it's challenging.
So as you mentioned, that's been kind of your life's work. The utility industry, as it sits today, is in sort of this state of change, whether it's technology and policy and that type of thing. We've talked a lot about what you spent a lot of time working on and where most of your expertise is on. Is there anything, coming and working here now and working with maybe a slightly different set of folks on a slightly different set of issues? Is there anything that you knew or interesting that you find that you're drawn to or that you want to kind of start digging into and learn a little bit more about?
So I have my hands full with the things I've talked about. What's interesting, and so in 2014, I wrote an article with my colleague Elisa Graffi about is there going to be a death spiral in the utility industry, which is a finance issue, but it's not on the front burner right now. The utility industry, with its regulatory, I'm going to call it protection, is extremely resilient, financially resilient. I mean, like in the 2010s, utility energy stocks like Exxon, people sometimes say energy stocks and they mean utility stocks. Energy stocks and utility stocks are distinct. But like from 2010 to 2020, approximately in that period, Exxon's stock price was lower at the end of that period than it was at the beginning. Why? Because sort of the greening, the carbon reductions, people trying to use less fossil fuel, they got hammered. ExxonMobil got kicked out of the Dow Jones Industrial Average. They were in that since Exxon is John D. Rockefeller's old Standard Oil in New Jersey. They've been in from way in the beginning, and in 2018 or 19 they got kicked out because they were not valuable enough. At the same time, let's just take little MG&E, and I don't mean that as a pejorative sense. They're much smaller than Exxon. Their price doubled. Utilities just keep going up. And they go up because they've got good regulatory protections. If things happen, their sales go down, and they get a rate increase. Their costs go up, they get a rate increase. And some of those are well-deserved. The question is, how much should it be? That's what we work on. But when Elisa and I wrote that article, we didn't predict there would be a death spiral. We said you have to watch, and guess what? We've watched, and nothing. There's no sign that they're in trouble. There's no sign. So the question is, how resilient is that regulatory protection? And it seems like it's pretty resilient. It seems like, and what would be something that would cause that resilience to go away? And it would have to be some kind of massive technology thing that's on the customer side of the meter where they could actually leave the grid, which is, even with storage and solar, they're still not leaving the grid. And so as long as you have connected to them. So I was looking for things like that in the last 8 years. And I remember I gave a talk actually to MG&E, to their management team. And I looked at their stock price and I said, I see no threat here. Your investors aren't stupid. I see no threat of any kind of death spiral. I just see the stock price nicely proceeding up the hill. And that's what I've been looking for. So I don't know if I should just keep looking for that. I mean, it'll show up in stock, but it would be nice to anticipate it. But I'm trying to think, I thought maybe self-generation would do it. But if you think about it, let's say you wanted to self-generate 100%. Why would that be complicated for you? Putting you on the spot. Why would 100% self-generation be complicated?
100% self-generation. If I take away all of the different considerations of different technologies, and the biggest challenge is that is you would have to be your own utility, and you'd have to balance. You'd have to supply what you need hour to hour and make that work, right? Because if you want the lights to stay on the same way when you're connected to the grid, then you got to make that flow.
And who might be able to do that? A big industrial customer. But are they doing it? No, they don't. No. They still don't self-generate. I mean, they have some. They might have some cogeneration and things like that. But so as long as the utility, and that's a valuable, the balancing thing that the utility provides, those are valuable services. As long as they have something that's valuable and you need them, then we're very unlikely to have any kind of death spiral. And so that seems like it's further away than it even was when I started in 2014 with Elise looking at it. As I said, we didn't predict a death spiral. We just said, here's the framing that you would use. That's in the Energy Law Journal article that we did. So I've kind of just said, well, I'm going to just keep watching. I'm not going to spend a whole lot of time thinking about it as I just keep the utility stock prices going up. Exxon is more in trouble. That being symbolically, if you can imagine being ejected from the Dow Jones Industrial Average, had to be massively depressing for them in terms of just psychologically having been like, the Dow was formed in 1896. I don't know if they were one of the original ones, but they were in there early. And then to be actually excluded, and you'll like this. Do you know what company replaced them? I'll give you a hint.
Apple?
No, they were already in. It's a company that you know, and it has to do with customer CRMs, customer Salesforce. So think about the economy changing. Energy out, Salesforce technology in. That's how the economy is going. But the utilities just keep chugging along. But there's a massive change. I actually was just looking at this with Rich the other day, our what's his title? Our
Director of Outreach.
Director of Outreach, showing him how the Dow Jones Industrial Average had changed from when I was born in 1956 to what it is today. And there's only 3 companies that are still in: Procter & Gamble, Boeing, which was called United Aircraft at the time, and Chevron. So there's one energy company still to survive. Everything else, the other 27 companies are gone. Like American Smelting, how's your American smelting company stock? American Nickel, American Distillers, corn products. They were like, what was the economy in 1956? It was a combination of agricultural processing. Bethlehem Steel was in there. Heavy industrial and agricultural processing, and 2 retail stocks. All right, I like to put you on the spot. What would have been the big retailers in 1956?
Sears?
That's one. That's very good.
JCPenney?
Woolworth.
That was my third guess.
And they're both. There's still a few Sears. I think there's like 40 Sears stores left in the United States, and Woolworth got absorbed into somebody. But if you look at that, and what has happened to the utility industry? They just have gone right along with that. That industry is such a core basic need that it has not changed. So I think I wasn't really expecting a massive change, but I see no threat. I don't see any tenable threat, any sustainable threat, because you're not going to self-generate even if you could. It's just too complicated. If you want to have the quality of service that you have, and big companies aren't going to, American Family's not going to self-generate. All these big entities are not going to self-generate. And if they don't, then utilities must be providing a service that's worthwhile. That's going to be a core value proposition for them. So now, is there anything else then that's replaced my thinking about what might be interesting? Well, I'm pretty busy with cost of equity and capital structure. I do think there's some things that came up in the Rice case, like forecast. Another forecasting issue, like forecasting gas prices. Those forecasts are as bad as the interest rate forecast, but we use them as sacrosanct. So those are related issues to what I do. But mostly, I just wait for you to give me something because I've got enough. If you don't give me anything, I'm busy for the rest of the year. I have plenty to do with the cost of equity and capital structure issue. That'll keep me busy. So I'm always interested in other things, but in terms of resource time, if you want to study something, if you were Tom or Kara or want me to study something, I'll do it gladly. But you're probably gonna have to identify it more than me. I'll look, but I'm just gonna keep my head down.
You got your thing. It works.
I got it, and it's a lot of work, but I like it. But I stand ready to address any other problems. But I don't know if you see any big issues. I know I'm not looking for an assignment right here on the podcast. But is there something that you think we need to go into that would require finance and economics, and again, I'm not really putting you on the spot, but that would be my question back to you. Like, well, what else is there? What do you see? I mean, there's some interesting cross-fertilization on the legal area with Kara, like the court cases that I know. She's the attorney, but I know in a very narrow vein, I know the return on equity court cases, Hope and Bluefield. She now actually, with working with me, knows them all just as well as me. But we're trying to find, can we pull, so it's not so much economics and finance per se, but it's putting that in actually a legal context. And you know that Kara and I are working on a paper with Jan Beecher at Michigan State, who is the director of the Institute of Public Utilities there, to try to actually, I'm the finance module, Kara's the legal module, and Jan's the institutional module. And we're trying to write some things to say, hey, let's try to, because in a rate case, it's not like just here's one, it's like 73 decisions. And there's an integration of those decisions. So that's actually some of the most interesting stuff I'm doing, is trying to work with people like Kara and Jan and try to say, how does this all fit together? Because it gets a little esoteric and technical if I just stay in my lane. And I can easily lose people no matter how good I am at explaining things, because how does it slot in over here? That's really probably more important than any kind of modeling I can do, is can I carry the idea from the finance lane into the legal institutional lane? Regulators are much more comfortable with legal and institutional issues. Finance seems like causes them a headache, if it gets really technical. Should the beta for a capital asset pricing model be adjusted for regression tendencies? I bet if I ask the commissioners, that's actually a big issue in every case. I bet you they don't have any idea.
That's not, eyes just glaze over.
That's not to criticize them. That's so technical. It's so deep into the and the ability of anybody who has to deal with the breadth of issues to dive that deep. It's just like, it's very unlikely that they would, even if they understood it one day, like a week later, they probably won't. So my task, working with someone like Kara or you or Jan Beecher or Tom, is like, what does this mean in a way that people can digest it? It's not because people are stupid, but they are not going to read a 41-page article on regression tendencies of CAPM betas. And they shouldn't. They shouldn't have to. Okay. What does that mean? Here's the short answer of that. That means that utility stocks are actually even less riskier than they might appear. I just told you that they just keep chugging along. That's a low risk. And the beta is a kind of a measure of risk. And some people think those betas are going up. That's a regression tendency. Turns out they're not. This is critically important. They're not getting riskier. The utilities are no more riskier than they were 10, 15, 20 years ago. And you often hear that they are. Well, that regression beta will tell you that. So it's a huge issue. Can we take that and then say, hey, here's the evidence that they're not getting riskier? That's a nice story, isn't it? Now the question is, can I do it? Can I make that connection? And we have data that shows that they're not converging to one. The question is, can I get the regulators to understand that these two arguments are the same? It's like risk over here with the data, and are they getting riskier? And if I tell the Exxon and MG&E story, and I say, look, Exxon has got kicked out of the Dow Jones Industrial, and MG&E is chugging along. Why? Because the risk of the utility industry has been stable. It's not that they're risk-free. They're just not more risky than they were before. Now, that if I don't have any data, now this just becomes a debate of people that have no data. Then it becomes a kind of a hollow debate, because yes, they are, no, they aren't. But if we could say, wait a minute, we can actually show that. We can actually, and so that's the kind of thing. And someone like Kara's good because she wants to know, when she works with me, don't tell me about the non-parametric regression model. Tell me about how can we, and that's good. I mean, we're a team. That's what we should do. And I know that I have to. It's not like it's a new idea that I can't use the non-parametric regression model. I know that. It's like, help me figure out where it goes as our team. Where does it go? How big of a deal is this? Like, there are some arguments that maybe aren't worth pursuing because they're way too technical, and all we'll do is get people, there's a thing about argumentation is that you should have one or two good, strong arguments, and the more weak arguments you mix in, it pulls your whole argument down to the weakest one. So that's another strategic thing for us to think about is like, what are our big ones? We might have to, this in terms of cost of service. You let some things slide. It's like, I know that's not right, but it's not big enough. It's not the one, and I can't make a compelling case here. So these two, one or two. So that's kind of in terms of strategy. That's as a regulatory strategist. That's really our big challenge. Is so let's pick off a couple of these, and if we take too many, we're self-defeating. We're going to start to. Steve has 7 reasons why that model's wrong. It's like, how about 1 or 2? They could be 7 could be right. If I was in the seminar, I'd get credit for all 7, but I'm not going to get credit for any of them. If I use 7, it just gets. People go, I don't know what he's talking about, or like, that's not even finance. Well, it actually is finance. I'm doing finance, whereas what we're doing in regulation is sort of like I call ad hoc finance. It's sort of pseudo finance, but it has a lot of cachet because it sounds good, and we've been doing it that way. So that's really, our team has to. We've talked about this. What is our strategy going to be on these issues? Which of these are we going to go after? And what are the most compelling cases that we can make? So we have how many rate cases? 3 full rate cases this year that we're going to be working on?
3 full rate cases, 2, we'll call them half rate cases.
So we'll get a chance to try to do that. I think we've learned some lessons in the previous cases about what we need to provide a little bit more quantitative stuff on. Sort of, this will mean something to you, maybe not to the viewers, but we got to put some more quantitative limits on our ranges for return on equity. That will help, I think, because the commission looks at our testimony and says, I don't know what to do with that, even though it might be right, but I don't know. Well, we're going to try to help them. We're going to start bringing things. Numbers mean a lot more than ideas when you're setting a return on equity. So that is an innovation we're going to try to bring into the cases. So anyway, as I said, that alone keeps me busy, but I'm ready to do anything else if some emergency arises, which seems like they do every other month.
Oh, there's always some sort of emergency. That issue you raised about utility risk and death spiral and that type of thing is interesting, and maybe we can talk about that some other time. But it's not just the cost to necessarily to the customer, the difficulty of just self-supplying and like leaving the grid, but it's also we've invested trillions of dollars in the largest, most complicated machine man has ever built, and we don't want to just throw that away if we don't have to.
Right.
So
I think
it's interesting.
You probably heard that the grid was voted by, I don't know if it was the National Academy of Sciences or whatever, the National Engineer, is the most significant contribution to the 20th century. And it is. I mean, if you looked at like before the Rural Electrification Administration, when farms had to run a manual or literal horsepower, the productivity gains when they got electricity were massive. So, we know that if we don't have it, we know that, electricity service is just gas and water as well, but electricity is a little more ubiquitous, is a great benefit to society. And so, we want to make sure we're not trying to kill the system. We just want to make sure that people don't have to pay more than necessary. We want to keep investors providing capital, and we want to keep customers not paying excessive bills. It's the ultimate consumer versus investor balance. So, but nobody in this organization is trying to gut the utilities. There's a core value proposition there. We're on this podcast today. The lights have not flickered. The camera keeps going. It's fantastic. We want to keep having that quality of service. So we're really trimming around the edges and maybe trying to steer the ship. That's the longer term thing, is can we steer the ship in a different direction? But we're not trying to send the ship over the waterfall. We're trying to actually make sure that we're headed in the right direction.
Cool. Well, maybe we'll definitely actually have you back on. Maybe you can we can have that more PhD level talk about finance and all the things you're working on. But this has been great. Thanks for coming on.
Thanks for having me.
Thank you, Steve.
Yes, you'll be seeing us in banging the drum in hearings and making all these points. But there's a lot of interesting stuff going on. So I'm glad to be here.
Cool. All right. Catch you all in the next one. Thanks.